Rakesh J. Jhunjhunwala is an Indian billionaire stock trader and investor, one of the richest in the world. Forbes estimated the 61-year-old's current net worth to be over $6 billion, seating him comfortably among the top 50 billionaires in India and the top 500 worldwide. Often referred to as India's Warren Buffett, he's one of the most popular and respected investors in India. How did an average man from Mumbai with just 5,000 rupees become one of the most successful stock investors in Indian history? Rakesh J. Jhunjhunwala was born in 1960 to an average family in Mumbai, India. As a child, he would often hear his father, an income tax officer, talk about the stock market with friends. Rakesh was intrigued by the topic, and so he asked his father one day why stock prices were always fluctuating, to which his father told him to go read about it, and read about it he did. It wasn't long before Rakesh took interest in making a career from the stock market. His father advised him to go further with his studies in college, which he did, and he later graduated in 1985 as a chartered accountant. He started his investment journey with only 5,000 rupees in that same year and made his first big cash in a year later, earning a staggering 500,000 rupees. The rest, as they say, is history. In the last 200 years, over 90% of the world's millionaires have been created by investing. Almost everyone you ever knew who has more than $1 million to his name did some form of investing to get it. Investing is one of the smartest and fastest ways to join the seven-figure club, and every other club for that matter. So how do you go about investing? Well, like everything else in life, there is the smart way, and there is the way that sends you right down to why did I do this vil. For every Rakesh J. Jhunjhunwala that made it big in the investing game, thousands, if not millions, failed horribly. What then is the smart way? How do you go about investing to make sure you succeed? How do you wade through the waters and come out with a W and not an L? 1. Learn, unlearn, and relearn. As Charlie Munger, a billionaire investor and vice chairman of Berkshire Hathaway, put it, go to bed smarter than when you woke up. Financial literacy is the single most important requirement for proper investing. It is the simple truth. You cannot make good investments if you do not know what good investments are. Learn about money. Learn about the psychology of money and how money works. If you are a stock market investor, study the stock market and what makes stocks rise and fall. If you are a real estate investor, know which assets bring in the best returns and when to hold on to assets or when to sell them. Millionaire investors, regardless of their level of success, are always learning. Sarah Stanley Fowler, the director of research for the Affluent Market Institute, surveyed over 600 millionaires in America and found that millionaire investors spend an average of 10.5 hours a month studying and planning for future investments, and you must be prepared to study and learn as well. One of the best ways to learn is to learn from those who have already succeeded. Read books written by popular investors. Listen to stock market and real estate podcasts. Surround yourself with tried and tested information. The more you do that, the better your decision-making. There is an art to investing, and it is those before you who know it the best. Wait first. You're not the only one on the road to your first $1 million. We are also, click the like button if you're interested in making your first $1 million soon. 2. Think long-term. Warren Buffett has given a wealth of investment advice over the decades, and one of them is to think long-term. He said, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. While it is a much more tempting option to invest in businesses that are hot at the moment, it is not always the smartest. A lot of stocks and companies have been known to start on a bang and fizzle out faster than a matchstick dipped into water. On the other hand, some businesses start small and seem unpromising, but upon scrutiny, they turn out to have huge potential. Warren Buffett thinks about the longevity of businesses when determining what to invest on. That is why he spent over $1 billion on Coca-Cola stock in 1988. And judging by how massively successful the company is today, it is clear he made a very good decision. Successful investing isn't about getting rich quick. Prioritize long-term, stable investments over short-term, risky ones. 3. Diversify your portfolio to a point. History has proven time and time again that when disaster occurs, the ones who sink first are the ones with both legs in the water. The Great Depression, the Great Recession, and even the recent COVID-19 recession all sing the same song. The more centralized your investments, the more damages there are to suffer when things go south. Do not put all your eggs in one basket. Do not put all of your money into one stock or one sector. There are multiple forms of investment, each with their benefits and risks. The stock market can crash. Real estate can immediately become a liability when nobody is buying them. Diversify. Have a hand in as many pies as possible. That way, you will be able to minimize risk and maximize reward. There is an asterisk to this, however, because there is such a thing as too much diversification. Warren Buffett and Charlie Munger have said countless times that they do not like diversification very much. They choose a handful of businesses they know work well and sit on them. Why else do you think they still own shares at Coca-Cola? If you can identify 6 wonderful businesses, Buffett said, that is all the diversification you need, and you will make a lot of money. I can guarantee that going into a 7th one instead of putting more money into your first one is a terrible mistake. Very few people have gotten rich on their 7th best idea. 4. Stay on course. Don't watch the market closely is another piece of advice from the billionaire CEOs, and it sounds a little counterintuitive. You might be wondering, how else am I supposed to know what to invest in or when things aren't going well? What Buffett means is that you should never make an investment just because everyone else is doing it or because the news said it's a good idea. The bandwagon effect is a very present phenomenon in investing. A lot of people simply go with the flow. But the problem is, the crowd isn't always right. There will always be a hot stock on the market. There will always be a new big thing, and everyone will tell you to come and join. Many new big things become colossal failures in the end, and the blame will be squarely on you for not doing your homework. Do your research and make wise investment choices. There are times when the market will dip, and it might be tempting to sell out your stocks as fast as possible, but keep your ground and understand that the market will always be volatile. Rakesh J. Jhunjhunwala's most important investment policy is to buy right and hold tight. This isn't to say you shouldn't bail out if an investment is crashing and burning and sinking to the bottom of the sea. But if you have done your research and made proper analysis beforehand, you would almost never need to jump ship in the first place. You would most likely weather the storm and keep going. 5. Never lose money. Warren Buffett gave another one of his quotable investing advice years back. Rule number 1, he said, never lose money. Rule number 2, never forget rule number 1. But what does this mean? Is it possible to never lose money? Buffett himself has lost billions of dollars over the course of his career. So why is he holding us all to a standard even he couldn't uphold? The truth is, his golden rule isn't meant to be taken literally. What he means by never lose money is that you should always preserve your capital. In whatever investment you make, always make sure the value you get is more than the price you pay, otherwise that's dollars going down the drain. The rule applies to lifestyle and non-business purchases as well. Do not spend on items you do not need or will rarely use. Do not get bad debt. Do not drown in liabilities. Warren Buffett monitors his spending almost niggardly. The 90-year-old has billions of dollars, yet his home and lifestyle do not show it. He once said that Wall Street is the only place that people ride to in a Rolls-Royce to get advice from those who take the subway. Spend on necessities, not swag items. Any money above the amount required for a balanced living should be put into savings and investments. Your goal is to accumulate wealth, not squander it. The bottom line. In the end, being a good investor is knowing that there is no golden egg in investing. There is no surefire method to success, because if there was one, we would all have used it 10 times over. You can't know what business would thrive for years and years to come. You can't know the perfect real estate that would never bring losses. You can't know what works all the time, but you can know what has worked 100 times, and usually, it is most likely going to work again. That's about what to expect on your road to your first $1 million. Thank you for sparing these few minutes. We hope we've made you better. To learn more, skim through our recommended video section.